Welcome back to Investing Talk Podcast. Today we're tackling a question quite a few of you have asked about, focusing on a company really making waves in the clean energy space. Is STEM a good time to buy right now? We're going to take a close look at this company, pulling insights from the latest data we have up to July 2025 to really help you understand its potential and, well, its pitfalls too. And hey, before we jump in, if you find these discussions valuable, please think about subscribing, maybe hitting that like button and leaving a comment. It honestly helps us a lot to bring you more of this content. And if you're feeling extra supportive, maybe consider buying us a coffee. Plus, definitely let us know if there's a specific company you want us to explore. Just leave a comment below. Your input really does shape what we look into next. Okay, so let's get started. First things first, who exactly is STEM? They operate in that sort of nexus of AI-driven energy software and services with a specific focus on clean energy assets.
Yeah, and the significance there, it's not just about STEM itself, but the whole sector, right? It's growing incredibly fast, just packed with potential. And STEM's angle, focusing on the software side, that's a really key part of their strategy. They're selling the brains, not just the batteries.
Like the intelligence layer. So strategy is one thing, but what about the financials? Let's unpack STEM's financial health, starting with revenue. The latest trailing 12 months figures show roughly $151.63 million. But here's where it gets interesting. You see this contrast. A solid 27% year-over-year revenue bump in Q1 2025. And that seems largely driven by their PowerTrack software platform.
Your AI platform, yeah.
Exactly. But then you look at the full year 2024 and revenue dropped nearly 69% compared to 2023. That's quite a swing. What's going on there? Is it a transition, maybe some restructuring?
Well, that dip, it definitely catches your eye. But look closer, their gross margins actually jumped significantly by 46% in that same period. So what that tells us is they're likely shedding lower margin business, maybe hardware heavy stuff, and really doubling down on the high margin software and edge device offerings. It suggests a strategic shift towards, let's say, quality over quantity of revenue, more capital efficient.
Yeah. Okay, better margins make sense strategically, but then there's this number, a net loss of around, what, $806.71 million? That's still a huge figure.
It is, absolutely.
And negative earnings per share, too, like negative 99.06. How do we square that with improving margins? What stage are they really in? Although,
yeah,
here's the positive twist, right? They generated positive quarterly cash flow from operations for the first time, $8.5 million.
Yes, and that $8.5 million in positive operating cash flow, even with the net loss, that's a major milestone. It signals, better operational discipline, maybe a clearer path towards funding their own growth, those big losses. Often typical for companies in high-growth tech sectors like this, they're investing heavily R&D, sales, building out that platform. It's a bet on future market share, sacrificing short-term profit for long-term dominance, potentially.
So it's an investment phase story. Given that and the current market cap, around $112.29 million, how are analysts actually valuing STEM? Can you even use typical metrics?
Well, exactly. A standard PE ratio, that's out the window because of the losses. But analysts look beyond that in growth sectors. They compare the valuation to the potential size of the prize, the future earnings power. And relative to that potential, the current valuation does look, well, potentially low.
And it seems analysts agree on the potential upside, right? The consensus price target is around $23.38.
That's right.
Which implies, what, a 73% increase from where it's trading now, around $13.50? That's pretty substantial.
It is. And if you zoom out even further, those long-term forecasts get really ambitious. We're talking projections, way out to 2030, even 2050. Hitting potentially $72, $74. Of course, forecasting that far out is inherently uncertain, full of caveats, but it reflects a strong belief in the underlying growth trend of clean energy tech and STEM's place in it.
Okay, so financials and analyst views paint one picture. What about the market's reaction? How has the stock actually been behaving lately? We saw a pretty dramatic surge recently, didn't we? Up something like 32%, maybe even 55% in the last month alone. That suggests some bullish momentum returning after a weaker period.
Absolutely, but that surge also highlights the sheer volatility here. I mean, look at the 52-week range. $5.81 on the low end, $33.60 on the high end. That's massive. So yes, recent moves hint at an upward trend trying to form, but there's likely going to be significant resistance near those previous highs. It's definitely not a smooth ride.
So what's the overall investor sentiment right now? Those Q1 results, the positive cash flow, that must have boosted confidence a bit.
It definitely prompted some optimism, no doubt, seeing those milestones hit, especially the cash flow. That gets attention. But, context matters. The stock is still down over 45% year to date, so there are clearly lingering concerns, likely tied to that 2024 revenue drop and the ongoing losses. And look at analyst ratings mostly hold. It suggests caution. They see the potential upside in the price targets, but they're not quite ready to shout buy from the rooftops yet. They probably want more proof of consistency.
Right, waiting for more data points. So looking ahead, what are the key things that could, really move the needle for STEM? Any specific catalysts on the horizon?
Well, the most immediate one is the next earnings report. That's expected around August 7th, 2025. That'll be crucial. Investors will be laser focused on seeing if that positive operating cash flow continues, if margins hold up or improve further. Longer term, the big picture drivers are things like the continued adoption of clean energy software across the industry and how effectively STEM integrates more advanced AI. Those are the macro trends powering their potential growth.
Makes sense. Okay, but no investment is risk-free. We have to talk about the downsides. What should potential investors really be aware of with STEM?
Definitely. There are a few layers of risk here. First, stock-specific risks. Those large net losses and the negative EPS we talked about, they underscore the ongoing challenge of reaching consistent profitability. And as we just discussed, the high volatility and that wide trading range, that's a big risk, especially for anyone thinking short term. Then you've got sector risks. Clean energy tech is super competitive, right? And heavily influenced by regulations and government policies. Success really hinges on technology adoption rates and continued political support. And finally, don't forget the macro picture. Things like interest rates, broader energy market dynamics, even geopolitical stuff. All of that can impact valuation and growth prospects for companies like STEM.
Okay, so that's a lot to weigh. Bringing it all together then, for our listeners wondering, is now a good time to buy STEM? What's the bottom line?
It really is a complex picture. If I had to put a number on it, maybe it's 6.5 out of 10. Look, STEM shows real, promising, long-term growth potential. The move to software, the improving financials, especially that cash flow turn, are all positive signs. And it's a significant, but the short-term volatility is high, and those ongoing losses mean there's still considerable uncertainty and risk. So who is it for? I'd say STEM is probably best suited for long-term investors, people willing to stomach that risk and volatility for the potential emphasis on potential for significant gains down the road in clean energy tech. For short-term trading, you could try to play the momentum, but you need very strict risk management because it can swing wildly. It's not for the faint of heart.
And if someone's considering it, perhaps leaning towards that longer-term view but wanting a decent entry point, any thoughts on a potential price range? And how should they manage risk?
Given the recent volatility in the trading range, waiting for a dip might be prudent. Maybe looking for an entry somewhere between, say, $9 and $13 could offer a more balanced risk-reward. Try not to chase those big spikes. For risk management, if you're trading shorter term, a stop loss is essential, maybe 10-15% below your entry. And consider taking some profit if it approaches those resistance levels analysts mentioned, maybe around $20, $23. Long-term investors. Their strategy is different. It's more about deciding if you believe in the multi-year story and being prepared to hold through the inevitable ups and downs, anticipating that growth trajectory over the next 5-10 years or more.
Wow, okay. That really unpacks STEM from a lot of different angles. The numbers, the risks, the exciting but definitely speculative potential.
Yeah, speculative buy is probably the right way to frame it. Significant growth potential, yes, but it absolutely comes with notable risks. It really fits that growth slice of a portfolio for investors who have a higher tolerance for that kind of uncertainty in a fast-changing sector.
Absolutely. And maybe a final thought for everyone listening to mull over as they consider all this. How might STEM's strategic shift, really betting on software, and their whole journey towards profitability, how might that influence the wider energy market, not just its own stock price? Something to think about. Thank you so much for walking us through that analysis, and thank you all for joining us today. Until next time on Investing Talk Podcast.